Hi, everybody. It's Barry McGuire here for Barry McGuire's Creative Real Estate Education. It's time for the Monday main event. Every Monday we get together and talk about creative real estate things, subjects near and dear to our collective hearts. Before we get going, though, for folks who haven't been on one of these before, we might have a few, since our pal Scotty Galloway's invited a few people to join our group, and we might have a few new people on. So we are, a creative real estate education group, and really what we're all about is we're looking to help you build your creative real estate business. So we talk about lots of different things. We have experts on. We've had the mortgage experts on, like Sean Impey has been on. We've had Robinson Smith on about the Smith maneuver. We've had insurance guys on. We've had accountants on. We've had trust lawyers on. We've had lots of people on to talk about their particular area of expertise and how it applies to creative real estate. We do an investor spotlight, which is kind of a hybrid of what we're doing today. Monica Paslawski is with us to talk about an RTO deal. And Sean Impey and Wayne Hillier are going to provide some support. Neil Taniguchi, maybe. I just saw him pop up there. So what we believe in this group is that education is the key to success in creative real estate. You need some education. It's a strategy that it's a number of strategies, all of which you have to learn about. It's like everything else in life. None of us got good at doing anything. Our jobs that we work at, a hobby, a sport, you can't get good at anything without getting some education and practicing. So to help out with that, we do focus workshops. We do them live, and we have virtual streaming workshops. Haven't done a live one for a while, although we are aiming at April of 2022 to do our famous Rapid Cash program. That's a 2-day event, full 2 days. Great breakfasts and lunches and networking and questions, and they're just super events. I think Monica was at maybe our first Rapid Cash. We'll get her to tell us a little bit about that. So what we want really to get you to understand about creative real estate deals, and particularly we want them to be win-win deals. We want them to be win-win. We do have a particular rent-to-own focus workshop that's available on a streaming basis. So you can go to barrymcguire.ca. That's one word, barrymcguire.ca. Check out what's available there, including the RTO program. Pardon me. Thanks, Donna. A little glass of water. Help me out here. All right. So today we're going to talk about a rent-to-own deal that Monica did, and she was kind enough to send me a really good timeline and summary, which she thinks she'll run through in 10 or 15 minutes, and then we'll be going, okay, what are we going to talk about for the rest of the hour? But I know that there's lots of things to talk about in any deal, and Monica's deal will be no different. So with that, our tech master, Wayne Hillier, who's going to participate as well, is going to bring everybody up, and we're going to say hi to them, and then we are going to get going. Thanks for doing that, Wayne.
You betcha.
All right. There's Monica. Monica, say hi to the gang.
Hi, gang.
Sean Impey can wave a hand at us. Ace mortgage broker, investor, in his own right, and joint venturer. Sean does a lot of things. And Neil Taniguchi. Now, Neil, are you in Calgary or are you back in BC? Where are you?
We're back in Airdrie. Yeah, we got home. We got caught in Hope last Friday because of the road closures on Highway 3, which actually, I guess, were kind of flood related because they had rerouted traffic, but it was actually a multi-vehicle accident that shut down that section of Highway 3 for quite a while. So we spent an evening got one of the last rooms in I think the Google review said, dated but clean motel in Hope. We made it home.
Well,
Honest.
when it's when you need a place to stay. Donna, my Microsoft OneWord is popping up here. I don't want to do that. I want to get out of that. I'm glad you got back safe.
Are you back in Elmworth now? Or are you still in Merritt?
Me?
No, he's
Oh, I'm home. Yeah. No, we got involved in that flood too, Neil. We were down there for a week mucking out our daughter's basement. So,
oh man.
yeah.
Not fun.
Oh man,
Yeah.
that's tough. But you're back now. So I always want to get a bit of background before we just start talking about your deal, Monica. Let's tell people a little bit about who you are. You and your husband Carrie are investors. How long have you been investing? You took Rapid Cash. You've got some properties you rent. Give us the history. When did you get started? And let's hear about you guys.
We bought our first rental property in 2001 in Grand Prairie. Yeah, I'm kind of a math person, and it cash flowed like crazy. But we called it the Great Teacher. We did almost everything wrong you could do wrong with that property as far as management goes, and we sold it about 3 years later. So Carrie said, "We're never doing that again." But I got interested and started taking courses. I went to RAIN. I learned an awful lot from RAIN. And then we started buying houses again in 2013 and 2012, I guess. We have 8 mostly buy and holds now. And then we've done tried a couple of rent to owns, one of which didn't work, but we still have that one, and the people who were in it were the original rent to own tenants, and eventually we really hope they do want to buy the place. We're doing a bathroom reno on it now, and it's done very well for us financially, and it's home for this Irish family. And so that's I guess where we're at. Everything is going well. The capital appreciation hasn't been what we thought buying in 2013. But we always kind of kept the RAIN said the worst case scenario is in 25 years, you've got a property that somebody else paid for. And at this point, that's where we're at. But hopefully we get some appreciation in the next few years.
Yeah, that's true. If you buy a decent property in a decent area, manage hard, and it cash flows, even if you don't get giant whacks of appreciation, yeah. And if you bought some of those in 2013, well, that's 8 years ago. So you're about a third of the way there. And who knows what will happen over the next while, especially with oil and gas having come back to some extent. Not that we're relying on that, anybody, but still there is, lots of movement in Calgary, I understand, and surrounding area. Lots of, Neil can maybe tell us a bit about that. What's the market like in Calgary and Airdrie and surrounding? Neil, do you have any sense of whether it's firmed up and rising prices, or?
We are still seeing, in single family especially, a shortage of product here. So the sales levels from the summer peaked there and have maybe come down a little bit. What's happened is inventory has been dropping monthly, and the sales rate really has not declined seasonally as expected. So I think there's less than 1 month supply overall here in Airdrie right now, not just single family. And single family has got to be well under a month. So we're on the cusp. We have a house that was a crashed RTO, unfortunately, and we've been renovating it, and it'll likely be ready December 15th. And in 9 times out of 10, that house would stay vacant until the new year and list it then, because you're throwing away days because you just can't compete with some guy named Santa Claus. This year we're going, maybe we should list it, even though it goes counter to everything we've always done. It's just, again, such a different year. So Calgary's the same. There's multiple offers still happening on the right product there. Apartment not so much, but certainly it hasn't cooled, and Alberta is seeing that run. That is not necessarily just fueled by oil and gas this time, which I think for all of us as investors is a good thing.
Yeah, we definitely wanted to not just be oil and gas. I know in my neighborhood here in Edmonton, in the old Strathcona neighborhood, every block has 2 or 3 properties listed for sale, and they've all popped up in the last couple of months, where normally you just wouldn't see it at this time of year. They're coming up, and some of them are selling. So, so things are moving along, and that'll fit into what Monica and Carrie are doing. So that was a pretty big gap, Monica. 2001, you buy a property, did everything wrong, as you say. And folks, this is the classic. So what Monica went through with her Grand Prairie property in terms of management, I think you said were your big issues. That's what happens. You study, you look, you check, you do, you know, and sooner or later you have to jump in and do something. But the great educator is buying that first property, that first damn deal to get you over the hump and to get you going, teaches you so much. Second deal, you learn some more. But Monica, although you were studying and looking and going to RAIN, and folks, RAIN is the Real Estate Investment Network, REIN. We call it RAIN, and we just abbreviate it that way. Great educational group over the years. So it was 2012. So that's, let's see, 1 to 4, sold in 4, started in 12. So you had an 8-year time period where, what are you doing in that time? Going to RAIN, fixing your chops, educating yourself some more. What are you doing over that 8 years?
Well, my husband started his own consulting company in 2001 as well. I was teaching half-time, and we have a farm. So in between, it was a smaller farm then. In 2006, we bought more farmland. So we quadrupled our holdings. So, we weren't doing nothing. And then in 2000, I thought of getting a master's. I was teaching, and I thought of getting a master's, and that was a real pivotal point for me, because that was about 2008. I thought, what good is a master's going to do? I don't want to be an administrator in the school system. That wasn't really of interest. I liked math, and I thought, no, I'm going to spend money, and we're going to buy a bunch more properties in the long run. That's going to serve me better financially and be more interesting. So that was kind of a pivotal point. But remember in 2000, I think it was 3 or 4, when we sold The Great Teacher, Carrie said, we're never doing that again. Well, after the studying and the RAIN, I tend to get trapped in a bit of analysis paralysis. And I had found a couple of properties in Edmonton, and he's the one who said it was a duplex. And he said, well, why would we just buy one? Let's buy them both. So we kind of balance each other out. So we quickly got our 8 properties between 2012 and 2015. This most recent one we did in 2019, I guess. So.
All right. So now you've got 8 buy and hold properties. And what led you to the creative side, and what did you do to kind of educate yourself creatively?
Well, going to your workshop, and I'm not just saying this because you've paid me, which you haven't yet, but maybe you will. That was a wonderful workshop. Of all the education that I've received in it, which I think was all really valuable, that was really inspiring. And I really wanted to do something with that. I haven't done a lot, but I felt that I could. We I don't know what happened in those years that we tried one in 2015, but I think probably the biggest thing was everything collapsed. And being up in Grand Prairie, we're kind of at the epicenter of it. Yes. As you guys know, Alberta went into quite a slump. The reason our first rent own didn't succeed is the guy he was on a temporary working program from Ireland, and all of a sudden his contracts, he was a welder and he still is, but he just wasn't getting work. And it just seemed like the outlook was poor to do rent owns. And I know a lot of people still did them and did very well, but we just we just hung on to the reins basically through that time. And we didn't do a lot with the education I received from you. And we did other things. I got involved in other things. I'm maybe a little distractible sometimes.
Well, a giant farm, a teaching job, a husband who has full-time consulting job, and 8 or so properties. Yeah, I guess you're pretty slack, Monica. I mean,
Well,
you just didn't jump right out and do something with that 2 full days of creative fire hose that we squirted at you there. at the Rapid Cash event. Well, I'm glad you really enjoyed it. I mean, that's our flagship program, and we do think it's very valuable. It's nice to hear somebody else say that. And don't worry, the check will be sent soon. Maybe I'll send it to you by ETF just to make sure you get it quickly. So just get that out of the way.
Sure.
Well, let's talk about your deal. So you did one rent to own with the Irish family, but his job and the collapsing economy didn't help, and so this next one came up, and in your notes you say it's one of your previous clients. So was your potential RTO tenant buyer a previous tenant, or how was he a client of yours?
He was a tenant in Grand Prairie.
Okay.
And so we knew him. He basically begged us to do this deal with him because he really felt that was the only way that he could get into what he wanted to be a permanent home for his little girl, close to where his ex-wife was. He'd heard about them. He didn't want to do one with anyone else. He said, I trust you. I know you guys would be fair and honest, and do you know how to do it? I said, yeah. And what I don't know, I have very good resources. And so we said, yeah, okay, we'll help you out. And I do feel that it was a real win-win in this situation.
So then when he rented in Grand Prairie, was he still married at the time, and he had a young daughter? Is that? It
was a recent breakup.
A recent breakup, okay.
And his credit wasn't good, and so he was actually, his ex-wife moved to Edmonton. They came from the island. They had a home there, and at that time the house prices were depressed on the island, so they lost some money in that home. They sold it, and he didn't tell me this, but I think in hindsight he helped her buy a home in Edmonton for her and the daughter. And he would drive to Edmonton to pick up this girl and bring her back to Grand Prairie for his weekends.
Well, okay. So folks, a really important thing here, as we talk about rent to own, and as we talk about creative real estate generally, is that Monica's previous client, who's the previous tenant, wanted to do a rent to own deal with her because he trusted her. And that's one of the keystones of what we teach on the creative real estate side of things, is that we always play for win-win. We build trust. We don't take advantage of people. And if that's the way you do business in this area, in any area really, but it's also important in creative real estate. If that's the way you do business, that's the reputation you get. That's what people sense when they deal with you. That's what they understand you are and who you are in these deals. And for somebody who's venturing into a new area or that really doesn't know very much about it, you can accomplish a lot when people go, I trust you. I know you're going to make this a win-win. That is ultra important for success in creative real estate. And sounds like, Monica, you established that while he was a tenant, and then it was when he was thinking, I need to get a home, you're the one he talked to.
Yeah, we were quite flattered, but yeah.
All right. So that's wonderful that he is a nice guy and that he trusts you. So what was he looking for? And let's talk about the numbers and how you put this deal together.
He wanted a fairly modest house. It's located just in that northeast area where the McConaughey area. He wanted to be close to his ex-wife and close to the school so that his daughter could easily transition between the places. He wanted to choose the house. We explained to him that it had to work and how it had to work. And so he actually chose the home. It's a 4-level split, just a fairly typical home that you could use as a rental. Had a single garage in the backyard of the alley. So we knew if the deal went sideways, we could rent it and cash flow it. So that was fine with us. So that's what we bought. My biggest concern at that time was Alberta's been in a rough spot for some years. There wasn't fortunately, and I probably shouldn't say this, but I felt there was a little more hope with the new government coming in. But still, I was a bit worried that there would be the appreciation required at the end of the day. But I was upfront with him, and we established a price. I said it's pretty well got to reach it. If it doesn't, then we'll still need to get there by alternate means. So that was my biggest hesitation.
Well, and fair enough. Let's talk a little bit for folks who don't understand the appreciation side of RTO and how that fits into the creative concept of rent to own. So what are we looking for when we're putting together, if we can get it, what are we looking for when we put together a rent to own deal? Firstly, in terms of, how long do you want them to run for? What's the term of the RTO? What's the best term in your mind? And why is appreciation important? How does that fit into the profit that you make?
I'm okay if somebody else answers that. I'm sure you guys can give. I can answer it.
Well, Taniguchi has been sitting there just waiting to answer a question. So, Anil, why is appreciation important in RTO, and why was Monica edgy about being in a flat or negative Alberta market?
When you think about, if you take, say, an average, and I'll pick a number, $300,000, $400,000 house. If you're putting your 20% down to buy it conventionally off of MLS, that's $80,000. And to answer to your second question first, typically, and Sean may chime in on this, the majority of rent-to-own clients are going to be folks who have some kind of bump or bruise in their credit. That means they can't qualify today. It can be other things. It could be that they have great credit. They just don't have a down payment accumulated. They don't have enough time on the job. They may not have grown into the income level they need, or their debt servicing is due. But typically, we find that they are people with a little bit of a bump or a bruise in the past, and they're recovering from it to get their beacon score up to where it needs to be. So we're looking for that 2-year time frame. Again, when we have an economy in this province that does this, it doesn't have predictability in terms of steady appreciation. Say if you were in the GTA or Vancouver, even Vancouver can have some ups and downs. But typically overall there's appreciation there. So if you were to buy a house for $400,000 and it didn't go up, or even worse, it went down in 2 years' time, you've bought the asset for $400,000 and you're going to turn around and sell it to your rent-to-own tenant for $400,000. And you really haven't made any money. Yes, you've made mortgage pay down, but as we all know, in the first 2 years of mortgage pay down, on a $400,000 to $320,000 mortgage, you might have a grand sum total of $10,000, $11,000, $12,000 in mortgage pay down in 2 years. And that kind of return on investment, when you consider the risk associated with laying out $80,000 to buy said $400,000 property, there's no ROI. For the investor, there's nothing in it for them. It's really good. You're doing your tenant a great favor, quite frankly, because you are putting your money into play and your credit and taking the risk on the property and the tenant. But to make $10,000 or $12,000 on $80,000 for 2 years there's better returns just to be in straight buy and hold rental. You buy a property that's better suited for that. So if you add in an appreciation factor, and in your case, Monica, would you share with us, was it a percentage or a number?
Well, the number ended up being about $25,000, and it's percentage. We used a percentage that we felt would work as a dollar amount. The thing about percentages, if you have a $400,000 house, you don't need to factor in as much of a percentage increase, right? And so that low, I don't think I'd ever do a rent to own for less than $300,000, because it's just, you might get a great percent return, but your actual return is not that great. Yeah. So we did.
ROI in percentage is one metric, but it's really what went into the till at the end of the day.
That's right.
As dollars. So I mean, if you made $25,000 on the example, and again, I'm not sure what your buy and sell price was. But even on the $400,000 example, now on your $80,000, you've made 25 plus say your 12-ish of mortgage pay down. Even if it's 10, that's 35,000. on 80,000, and Wayne's doing quick math. I can see him helping me out
No,
here. But
I need to be a little more accurate, Wayne. We actually, it was a $27,000 appreciation factor. At the end of the day, at the end of the 3-year term, we should have made almost $50,000 were my projected numbers.
There you go.
Because it only went for 2 years and 3 months. He wanted to close early. It was almost $40,000 was the net return after expenses. So.
And good on you to let them cash you out early instead of insisting that they went to the end. Because again, ask us how we know. We've had people who should have been qualified in their rent to own. They were ready to go and they were just slow in filing a tax return, going to see this person, getting that last little piece of the puzzle put together. But they were there and their situation changed very rapidly. We unfortunately had a fellow in rent to own who I think we're now coming up on month 3. He fell off a ladder off the house and broke his back. Survived, not working, was helping a friend out, so there's no comp. So now we're going, okay, what does it look like? We had another fellow in the midst of the pandemic who happened to be in Mexico and got sick down there and couldn't come home and got behind. So that they haven't lost. Neither of those two have lost their option with us yet, but it certainly has pushed things back. So we would agree with you. Anytime you can cash a house, there was a little bit of, shall I say, discussion in our household. We had a cash out in March or April of this year, and it had been purchased on agreement for sale. So it had a fixed rate mortgage in place, and the payout penalty was $14,000. And there's groans and moans going, oh, that's a lot of money to throw away. That's coming out of your rent-to-own profit. We said, don't care. We're gonna reduce the risk to 0 today and take a little less money and get our money out, and we can now put it back into something and starting again, because you just never know what happens.
Well, thanks for that, Neil. That's a great explanation of how that works. So a couple things coming out of that. Neil said we reduced our risk to 0. So folks, creative strategies and deals that you do with creative strategies are not guaranteed deals. RTO deals in particular, just because it all looks good and you think your tenant buyer is going to be able to qualify to buy the house and get a mortgage, it doesn't necessarily work. I'm not sure what the percentage is, and I think our group does better than most, but it's certainly not a guaranteed thing. And if you can reduce your risk to 0 and make some money and move along, that's good overall. I really agree with that philosophy. And the second thing is that as much as RTO deals work best and you make the most money in a nicely appreciating market, there's definitely a place for RTO deals when you put them together with other strategies, and that's something that we teach in our courses. We're not talking about that today, but I just didn't want everybody to go away thinking RTO is useless except in a guaranteed appreciation market, because it does have a space in other circumstances. So I want to bring Sean in here, because Monica's tenant buyer is split from his wife. And before we get some comments from Sean, what were his financial circumstances, Monica? Was it did splitting up in the divorce, is that what left him unable to qualify?
His credit score was fair to poor. And he had that loss that they took in Nanaimo. They got behind in some of their bills. So that was definitely a big part of it. He worked hard to improve his credit. He worked even as a tenant of ours. That was always on his mind. I've got to get back on my feet and improve my credit.
Well, I guess, for a guy like Sean, who helps people, they come to see Sean and say, Sean, I want to do this. Sean looks at their credit score, looks at other things, talks to them, and can probably tell them very quickly what they have to do. And so, Sean, every time you coach somebody on what's it going to take for me to get a mortgage, are they all as good as Monica's tenant, eager to improve and listening for coaching? And What are they like? What's it like for you, Sean?
A lot of lip service sometimes about getting their credit better. So if it's recent and it's event driven, like a separation or divorce or something, and they had good credit and it went off the rails because of marital breakdown or something like that, it can be fixed. That they had a good history, but the old saying about a leopard never changes its spots. So the ones that had always had bad credit, you can't expect them to do a miracle and change. So I've sent lots of people who are a little more, deep in the red off to my credit repair guy, and some of them never even contact him, or they're there and they don't want to spend a couple $100 to get their credit better. They think they can do it on their own, which is a big mistake. So they need someone to look at. So there's two things on the credit. Some it's just low credit because they've got they get credit cards and stuff like that, or they're carrying high limits and stuff like that. So that affects their credit score. But the others out there who are just, forget, once or twice a year, they forget to pay a bill and they got some R2s and R3s on their credit bureau. That's a whole lot worse than having, your just high limits on your credit cards and stuff like that. As long as you're paying your bills, they'll still be in the, what we call the R1s and the I1s, which is the best you can get. So if that's what they got, then it's just a matter they have to start paying down some of those bills. So now there's rent-own. We always look at three things. The threes of rent-own are cash, credit, and capacity. So cash is your down payment or what you're going to produce over time, and credit obviously is how good you are in your beacon score, and capacity is your job. And you can always fix the cash by saving more and things like that over time, and you can fix a credit, but you can't predict in 5 years you're going to have a job that pays you $30,000 more. So a lot of people get caught because they're just getting by on their expenses, they're paying rent and they don't have a whole lot of money saved up. Now they think, oh, let's get into this rent-own. We got a few $1,000s, and the investor will take that. But surprise, the rent that they're paying on their rent-own is about the same or maybe more than what they're paying the price. And what's this extra $600 a month we have to come up with? They couldn't save money and put it away when they were renting. What makes anybody think they can save up that money and put it away in a rent-own contract? So when I look at whether they can afford it, we always got to add that rent-own payment on top of it and see if that helps them out as well. And I'm finding it's better to kick them to the curb and than to have them fail and spend a bunch of money on them. So it sounds a little harsh sometimes, but you gotta really read. And I get all kinds of rent-own clients coming this way that really they're never gonna buy a place. They've always been renters. Credit's always been weak and never saved money. So really got to dig a lot deeper into them than just a normal mortgage client.
Yeah.
So, and one other thing, we talked about the appreciation and stuff like that. The other way to make money is the buy low. So if you buy at market in today's real estate situation in Alberta, if you buy at market, you have to expect to get that 3 or 4% every year to make yourself some profit. And the market hasn't shown us going up that much, right? So it's more a case that you got to find that property that's below market value for what reason. It's a little worn out or tired. You got to put a few rentals into it maybe to bring it up. But if you can make that money on the buy instead of trying to make it on the sell, I think you have a better chance.
So this
and I always pre-qualify people on their job to see if they can do the exit strategy. Same as when you're doing a BRRRR, right? You always you always make sure you can qualify for the mortgage before you do the work, because otherwise you're stuck. So you got to be pretty sure that your tenants will be able to qualify.
Yeah. Well, that finishing remark is, maybe the great summary, and all the things that you're talking about, Sean, are questions that revolve around, can the tenant qualify? Will the tenant be able to qualify? So for anybody who's considering a rent to own, a mortgage broker like Sean is really critical to do that deeper analysis of your proposed tenant buyer to help you decide whether or not this potential tenant buyer is somebody that you want to take a chance on. Because really, they can look excellent and you can get pretty good reports, and still people can't in the end qualify for a mortgage and can't pay you out. So the more work you do using professionals like Sean to answer those tough questions and dive deep into the whys and the wherefores of why can't they get a mortgage now, and if they can't, are the problems fixable, the more successful your rent to own will be. So very, very important. Thank you, Sean, for that. And we'll go back to Monica now.
One more
thing.
Comment. Yeah, just a sidebar to that is, I've come across this a number of times, is people to me and I say, let me see your contracts, your rent to own contract and your lease option and all the stuff you got. And some of them, I guess crap is a good way to put it. So they don't do the right things. They don't get their market rent opinion up front when they don't want to spend $100 on an appraiser to get that sorted out so the banks want to see that kind of stuff. They don't they don't register the agreement on title. Banks want to see that original agreement on title at the time it was entered into, so that they know there's no hanky panky going on. So, and if you don't do that kind of stuff, you eliminate a bunch of lenders for the tenant for the mortgage broker to take the tenant to. So not only the lawyer end of things and whatever real estate group gives you a rent to own type of paperwork, you need to make sure it's mortgage friendly when you set everything up.
So though, folks, for you listeners who have no idea what a rent to own is, this is high level stuff that Sean is alluding to here. And we could talk probably for the rest of the night just on points that Sean has raised and that he says are important. So this is rent to owns have a lot of moving parts to them. There are many things to know and many things to figure out and many things to make sure are in place to have the best chance of success that you possibly can with an RTO, a rent to own. So, Monica, I want to go back to you and your tenant buyer and your edginess about the market. And I think you said in your notes to me that you went over it very carefully with your tenant buyer, what you needed to have happen, and if it wasn't happening, what in terms of appreciation, if that wasn't happening, what was he going to have to do? Let's talk a little bit about that part and how you told him and made sure he understood about, okay, there she is. Oh, she's back again.
Sorry, I had to shut the door. I think Carrie might be making supper. Yay.
Excellent. Good, Carrie.
Well, Sean, I appreciate everything you've said. And man, I tried to dot all those I's with Greg. So he was working with a mortgage broker, not one that I recommended. I couldn't persuade him to do that, but he assured me that he was. And now I got a bit distracted with the questions. So we went over all the paperwork. I used everything that I had received from Barry's course. In fact, Barry, I think I had you go over the agreement when I started it, because you did the purchase for us as well.
Yeah.
So I used those agreements and I just went over them really carefully. I ensured that Greg got some independent legal advice. Again, he wouldn't use a lawyer that I recommended, but he did get his certificate of independent legal advice signed. And you know, as for the rest, whether he would ultimately qualify or not, he was certain that he would. He had all the right professionals that he was using, and I would check in with him every few months and just see how things were going. And sure enough, at one point last year, he said, and he had a pretty good option payment up front too, which it was decent. It was $14,000. So his monthly option payments, he could easily cash flow with his job, his employment income. And he asked if he could increase those monthly option payments. I said, sure. But I said, you know, if you just want to save on your own, that's fine too. He saved on his own. He came up at the end of the day, he actually had 20% down, qualified for a mortgage at, I think it was 1.4%.
Yes.
So that was excellent. I was very happy for him.
All right. So now we're at the point where why don't we go through those numbers? So Greg picked out the house, and it was a 4-level split with a single garage, and he went, well, if this RTO collapses, we can rent this out and make it cash flow, which is always an important question. You don't want to be buying a beat up mobile home 40 clicks out of town that nobody will live in if the tenant buyer doesn't want to live in it. So his choice fit the parameters of being, this is a house we can rent. So let's run through the numbers. What was the price and how did all the numbers fit in? Who paid what? And let's go through that part of it.
We did negotiate the price down by about $10,000, and it did. Greg actually did some renovations on it himself on his own dime. It was a little dusty, the house, and so he did some painting and he did some renovations in the downstairs bathroom. So just saying that he helped to raise the value himself doing that. As far as the deal went, we have a couple of another couple who have joint ventured with us on actually we call them the Damned Irishman's house. We love our Irish people, but we can't understand a word they say. Anyways, they're joint ventures on that. They are wonderful people. So we asked them if they're interested. They were. So they contributed $50,000, and we pulled $7,500 out of the other deal that we're in together. And then Carrie and I covered the rest of the costs up to the 20% down. We got the $14,000 option money. Market rent, as Sean said, the mortgage broker that I was working with, they calculated the market rent to be $1,660, which was $40 less than I had planned to charge. But so that's what we charged, and we had $250 of option money per month for our tenant buyer. Were those the numbers you wanted, Barry?
Yeah, those are the numbers. Now, what was the purchase price before?
$295,000.
$295,000. Okay.
Yeah.
$295,000.
Yeah.
So 20% down, that's $60,000. I see where it all came from. 50 plus $7,500 from your other project. Plus you got $14,000 worth of option money, which is a good chunk of option money. That's good.
Yeah. That gave us some confidence too. Yeah.
Yeah. We believe for folks who haven't done an RTO, you're better off if you can get a big chunk of option money up front rather than try and work with somebody who has not saved a bean. As Sean talked about, some folks spend all their money every month, and the reason they don't have a down payment or they don't have option money is they just can't save. And so if it's all going to depend on them paying an amount of money over 2 or 3 years, which will add up to a 20% down payment or even a smaller down payment, they're getting an insured mortgage of 5 or a 10%. You're better getting chunks of option money up front. Can't always do it, but you are better off doing that for sure. All right.
The toughest cash flow part of the whole process is when they're in that paying the option money, because once they get their own mortgage, they're going to be paying less than what they're paying the investor, right? So expenses should expenses should go down, so they're paying less overall, plus they're not paying the option. They should have another $300, $400, $500 a month in their pockets. So
should work out much better for them. So this was August of 2019 when you closed on the home. So 2020, 2021. So just under 2 years, I guess.
27 months it worked out to.
27 months, so just a little over 2 years. And how did things go? Any ups and downs throughout any times you were scared and going, what the heck did we do this for? Carrie saying, we're never going to do this again.
You know, I'll tell you, the worst hurdle was for Carrie and I to qualify for a mortgage. All of the other properties that we had purchased, I was teaching. Now, he makes way more money than I do in his consulting business, but it was that half-time teaching salary that got our mortgages. Sean might be able to tell me that, but at that point in 2019, I wasn't teaching. I was doing some contract work too, but that was a lot of work, and it seemed ridiculous to us how much work that was. But other than that, Greg was pretty good. He was consistent. He did try to get a new deck out of us, which would have only been about 20 grand, but we didn't fall for that one. And you know, he was good. Everything seemed to go well. The closing, I didn't know how to close one of these deals. I'd never done it before, and I read through all the material, and I wasn't sure what we were going to do with that option credit money. But Barry knew the answer to that, and he just applied it as a credit on the sale, and it was lickety split. That worked well. So I can't think of any real hiccups, Barry.
Well, that's good. I mean, there's generally hiccups. Now, Greg, your tenant buyer was doing so well that I think he wanted to close you out early, didn't he?
Yeah, he asked, and we were actually, I never have a fixed rate mortgage ever. I always do variable, but that time I had done a 3-year fixed mortgage. So I was wondering too about the penalty, and we kind of checked into it in August when he asked about closing early, and it was going to be, a few $1,000s. But we decided, and I'm glad to hear Neil say that was the right decision, that we would do that. We talked to our joint JV partners, and at the end of the day, just when we closed, interest rates had gone up on a 3-year term, and I think we only paid the 3 months interest. So it wasn't bad at all to break that mortgage. We got lucky.
Well, that is, that's fortunate. Now, folks, we did say earlier on and around the beginning that in our group, we play for win-win. We don't take advantage of people. We don't beat people up. But that doesn't mean just because somebody asks if you can pay for the cost of the deck at $20,000, or if they can close early and avoid the payout penalty of whatever it was going to be. It doesn't mean you have to roll over and play dead and still be in the win-win category. So I have no trouble with how Monica said, sorry, Greg, got to pay for the deck yourself. And yeah, you're going to have to pay those penalties. And that in the end was fine with him.
We paid the mortgage penalty.
Oh, you paid the penalty.
I told him, we'll cover that.
Okay. So 3 months wasn't too bad. Now, if it had been on the other side of a fixed rate mortgage break, it could have been very expensive. Sean, give us a couple of examples of people who sign up for the fixed rate mortgage, and then 6 months later they're wanting to get out of it. What kind of penalties can people pay to break a mortgage, a fixed rate mortgage?
Well, so if you had a mortgage you got back in early 2019 at 3.5 or 4% range, and you wanted to break it today, you'd be paying a really healthy penalty, because there's at least a 2% difference probably in the interest rate, plus lenders, the big bank lenders typically use what's called a discount rate, where they even take more off it. So you could be paying like 3% per year. So on a $300,000 mortgage, you could be paying $9,000 a year in per year left in penalties. So it could easily be those $25,000 or $30,000 horror stories you see in see in the paper if it's a couple of years back. If you get a mortgage, got one much more recently at a lower rate, rates have crept up in the last 6 months. So depending on the type of lender, you may only pay a 3-month interest penalty on a fixed rate mortgage. So it really, it depends on the lender, when you bought, and the difference. So 3 months interest is always the minimum. So
when I first looked into what the mortgage penalty would cost us, it was about, I think, $4,500 they estimated. We ended up paying, I can't remember exactly, it was well under $2,000.
Yeah, so there's a couple of things that come into play on the mortgage penalty. One is they always calculate the remaining term to the closest year that you got. So if you got 4 years and 7 months left on your mortgage, they'll use the 5-year rate as comparison. If you got 4 years and 5 months left, they'll use the 4-year rate. Now there could be, the 4-year rate could be cheaper possibly than the 5-year rate. So I had a client that we worked on here last year that her penalty was actually going to go up in about a month because the 5-year rate was quite a bit higher than the 4-year rate, and her mortgage was going to get compared against the 4-year rate. Her penalty would go up even though paid a couple more payments on it. She didn't understand it, but we hustled to get this thing done before we ticked over to that other day there. So sorry to cut you off there, Monica.
No, that's okay. I just had a question for you because I'm not sure if this made a difference or not. I didn't actually do the calculations, but there is a prepayment option with mortgages. Obviously, you know that, a certain amount every year. When I knew we were going to go ahead with this deal, I slapped as much cash as I could up to the limit of the prepayment options so that the mortgage, I paid down as much as I could without paying a penalty according to the annual prepayment options.
Yeah, that can be as high as 20% with some lenders and as low as 10% with some other lenders. So
I think
the key there is if you ask for a payout statement, sometimes there's a 30-day no-fly zone or something where you say, well, you can't pay it out and then pay your mortgage out the next day, right? So you think you're going to do that, you want to be careful how you're dealing with the lender to get your prepayment privileges. And it cuts down your penalty by, obviously, it could be way more than 20%, because if you had a mortgage of $400,000 and now it's down to $300,000, your percentage of payout still goes back to the original mortgage. So if you had $300,000, you could use, say, 20% of the $400,000. You could pay $80,000 down on that. So you actually get more than 20% down.
So folks,
prepayment,
this is good coaching by Sean. Lenders are very smarter than probably all of us will ever be, and they totally understand that if people are thinking of paying out their mortgages, they say, hey, I better take advantage of those kind of free pay down provisions in the mortgage to pay it down as much as I can before I have to pay the big chunk. And so that's why Sean says there's a no-fly zone. If you maybe for the 30 days before a payout statement is dated for it, they won't let you do those big payouts. So anyway, that's a bit of a rabbit hole and a sidetrack. I wanted to get Wayne in here. Wayne, I mean, you've done rent-to-owns, you've been listening. Have any comments on this particular deal, how it seems to you, and how that might have fit into any deals you've done?
Truthfully?
Yeah.
No. I don't have anything. I normally have something to say, but I don't. I really don't.
Well, moving on.
I'm sorry. This is going to be my big break. I've been waiting for like 54 minutes, and you finally asked me. I got nothing.
We're doing a good job. Neil, what about you? You've done rent-owns. Anything else to add in here before we get to concluding?
Well, first and foremost, I want to know what happened to Wayne.
I know.
Where's the notepad? Where's the 6 questions?
Yeah.
The quick comment is, man, congrats. Darn near the perfect applicant. Someone who actually wants to pay you more than their option credit and has that financial discipline to save on their own. The income level was there to support it, but they didn't fall into some of the pitfalls that we've seen. We've lost deals, unfortunately, because someone said, I have to have a new vehicle. No, you don't. That new $900 payment is, unfortunately, saddled you with 5 or 6 years, and now to try and get rid of that payment, and you're $10,000, $12,000, $15,000 negative just to get rid of that payment. So yeah, you again, we've talked about this in some of the courses, that the mindset of the people who you're taking on as applicants here, what I hear is someone who was determined, motivated, laser focused, understood what it took, and most importantly, then executed. Because a lot of people understand, you can explain to them, the first thing we need to do is you have this silly $60 collection from your cell phone bill 3 years ago. We have to pay that off now, folks. We can't wait 2 years. It has to wait today, because then your credit score will start healing as a paid collection as opposed to an unpaid collection, as an example. Yeah, okay. And a year later, when you're doing your follow-up, and we've actually, I think I heard you say every 2 or 3 months you were checking, and that's brilliant, because we've even started to go with certain of our children, so to speak. We have to be following them more often than that. And I've used that for years, the analogy that qualifying for rent to own and credit improvement is like physical fitness. This morning I did not want to do my workout, but we had a meeting with our personal trainer, scheduled an appointment, and so we showed up. Did we necessarily have the best workout ever? Well, it was better than no workout. And if we have regular check-ins with like we're talking about, we've started doing that. Saying, okay, in the first 30 days, you're going to pay that $60 collection off. We're on them now at day 35, 40, going, hey, just checking in. And you get to realize which of your tenant buyers are going to be the ones who are going to not need the physical trainer, coach, and financial, follow up to say, did you pay it? They'll get it done. They understand what's at stake here, and they have that drive. And listening to their story before you even go shopping with them, before you take their application, can be key to a lot of this stuff. So no, I don't have much to add other than, man, you got a good one. Congrats.
Well, then let's finish with the numbers. Let's finish with the numbers. So this was a joint venture for Monica. These joint venture partners they had were in on the property with the lovely Irish family that didn't quite work out, but they were they must believe in you, Monica. And so let's talk about your original numbers, what you projected you might make, and then what you did make, and how your joint ventures feel about it all.
Well, I actually called our joint venture partner just before I talked to you to get some feedback from her. So our original numbers showed a profit of almost $25,000 on the 50 that they invested over 3 years. So that was what we projected they would receive. After the 27 months, they will receive about 19 and a half. There's pennies still to work out with insurance rebates and stuff, but they'll receive about 19.5 on their investment of $50,000, which is a rate of return of 38.9% over 27 months. And it works out on a simple basis, not a compounded basis, to 17.2% per year for them. I just talked to Leslie. I said, can you give me some feedback? She said she felt it went very smoothly. She said the most work they did, and this is true, is to drop off some daffodils at Easter and some of our own beef that we had at their place, and they took them around to all our rentals because they live near Edmonton. So they dropped off daffodils and beef. They found it very easy to understand the reports that I sent them. They were happy with the open line of communication. And she also added, she was happy that I insisted on doing the agreements properly because they would have sloughed it off as we're friends and they trust us. And they were happy with the return. They would do another deal. So,
and folks, That's beautiful. As Neil said, big applause for how this whole thing went together. I think it's going to be a round of applause from all of us for you,
Yeah.
Monica. Yeah, done a really good job.
Well,
on
that's a good one, but wait till you hear from the tales of the trenches. But anyway.
All right. Okay, I'm going to hold you to that. Yes, all deals
The
don't
dark
go
side.
smoothly, folks. So we'll listen to Monica, see what she has to tell us about something else that will turn out to be something we call Tales from the Trenches, real life stories from investors who step in steaming piles of doggy doo and what they did about that, apart from clean the shoe. All right. Well, Monica, thank you very much for coming on and telling us this wonderful story. Lots of facts and figures. I found it interesting and useful myself, and I know Sean and Neil did. Wayne, I don't know what he found out of it but you know, we'll let
should
that
be
go.
happy that in this whole 1 hour session that we almost got all the way through without calling him Junior.
I know. Well, I'm trying to avoid that now. He's getting to be more of a senior guy. Look at that beard. He's got he's married. He's got a beautiful
A
daughter.
grown man.
Grown man.
Not against that to
All right.
say.
Thanks
Sizable
again,
boy.
Monica. Thank you, Sean. Thanks,
you
Wayne.
all.
Thanks, Neil. We'll say goodnight, and we'll see you at the next Monday main event next week. Thanks, everyone.
Bye, everyone.
Good night.